Right, good morning, everyone. Welcome to our Phillip Securities Research Morning Call for today. We will be covering the Singapore Banking Monthly, the SG Bonds Weekly, as well as a slight recap of our strategy for the third quarter, as well as some of the stock picks that we have in our strategy. Okay. Okay. So for the banking industry, we are still maintaining a neutral call. One of our first of the factor is that the interest rates is likely to stay lower for longer, although there was some resilience seen in April for the SIBOR and SOR. What we saw is that for May and June itself, it actually fell back to levels last seen in 2013 and 2014. And right now, what we are expecting is for the interest rate to stabilize at current levels. In this front, if you look at the table at the bottom right, what we try to compare is the NIM experienced by the banks during the 2013 to 2014 levels compared to the current reported NIM level, the net interest margins level that was reported in the first quarter of 2020. And we see that there are some downsides to it if it falls back to the 2013 levels. So across the board, what we are expecting about a 3% to an 11% impact to the net interest income for the second quarter to the entire year's net interest margins. Okay, so the part two is for the loans outlook. Loans growth actually fell to 0.51% in the month of May year on year. You can see that at the bottom left-hand table, where we see that over the past 4 months from January to April, we see loans growth was actually between 2 to 3%, but for the month of May, it actually collapsed to 0.51%. What we saw is that both business and consumer loans saw weaknesses. For business loans itself, it actually grew at the slowest pace in 13 months, despite growing at 3% year on year. So businesses are likely deferring some investments during the circuit breaker period in May, and we'll likely see some short-term headwinds as the companies go into preservation mode to see how the new business environment is. For consumer loan side, consumer loans shrank 3.48% in May, with housing, car, and credit card loans shrinking across the board. Although while we enter phase 2 of the economic reopening, we'll probably see some more consumer spending, but we expect big ticket item spending likely to continue experiencing weakness with housing, car going down, and people are likely not spending on tourism as well. So that's in the short run, loans will also weigh down the whole interest margins. So when we look at the banking industry, what we see is that people can only fall back on fee income to see any glimpse of growth for the financial year 2020. So on the screen, you can see some of the first quarter highlights across the 3 banks for fee income specifically. And what we do see is that as we exit a circuit breaker and go into the second half of the year, we have brokerage income. Brokerage income is likely to go upwards with the heightened capital markets activity. Not capital markets, but the equity markets activity, as well as higher wealth management as we enter reopening, where RMs can finally start meeting clients. And the branches start to reopen. So for wealth management itself, of course, in the circuit breaker period, they were affected when they can't meet face-to-face with clients. But because previously they were already experiencing a very strong business momentum, so if this recovery is seen on in the second half of the year, that would be great. Okay, so aside from the banking industry, we see that actually improved market sentiments allowed SGX to see better as securities daily average value and derivatives daily average volume are improving. So across the entire second quarter, next. So on the table, you can see I highlighted it in red. For the period between April to June, which is the fourth quarter of financial year 2020 for SGX, SDAV actually increased by roughly between 30 to 50% year on year from April to June. So this will help to bolster some of the income for the entire fourth quarter for them. However, for the DTAV side next, if we take a look at the right side of the table, we see suppressed levels for derivatives itself, derivatives volume. It was suppressed first. The first signs of suppression was seen in April. I saw some rebounds in May month on month, but if you compare it year on year itself, it's still down about 20%. And for the preliminary data that we obtained for June, for the top few derivatives data, what we see is that it has improved from levels seen in May, but it is still likely down between 15 to 20% year on year, because last year June period was also the period whereby there was heightened activity due to the US and China trade tensions. So all in, with the combination of SDAV improving and DDAV dropping, we expect SGX revenue to grow at about 7% year on year in the fourth quarter of 2020, which is about 5% of our current expectations. Okay, so right now, what I want to talk about is some of the news that SGX actually announced over the past week. The first news is actually SGX acquiring the remaining 80% stake of BitFX for US $128 million. So just last week, last 29th, SGX announced plans to acquire the remaining 80% stake of the cloud-based FX trading platform. So it is the sign of expansion for SGX to enter into the FX OTC market, which is actually complementary to what it has currently in its product offerings, which is FX futures. So with the strong the currency pairs that SGX actually offers under its FX futures, which is towards the Asian currencies, BitFX also has a strong product offering in G10 currencies and Asian currency pairs, so it will help to synergize, and it allows for potential cross-selling of products for SGX's current client pool and the clients of BitFX itself. However, they also announced that although the acquisition will be EPS accretive from financial year 2021 onwards, but it's not expected to have a material impact on the earnings yet. Okay, for the next piece of news, SGX actually launched the FTSE Taiwan Index Futures to replace some of the expiring MSCI license product. So the main thing to look out for was that actually this Taiwan index will replace the MSCI Taiwan index. And the main thing to note is that actually the MSCI Taiwan index that is expiring February of 2021 is the largest contributor among the MSCI products that SGX holds with MSCI. So it contributes about more than 90% turnover on a monthly basis among all the MSCI products. And it contributes to 13% of the total equity index turnover as of May 2020. So what we see is that if the successful launching of the FTSE Taiwan Index can replace the MSCI contracts, the impact with the cessation of the license agreement with MSCI will be not as impactful as previously expected. Next. Okay, so what we see is across these two news is that there's a prompt rollout of the expansion plans to ease some of the short-term pains with the previous announcement of ceasing agreement with MSCI in May itself. So this will help to serve as a prospective growth catalyst in the longer term. Okay, so that's it for me for now. I'll now hand the time over to Timothy, who will be talking about the bonds weekly.
Okay, just a quick update on the bonds, corporate bond market in Singapore. Okay, so right now we still see spreads for corporate bonds still at a cheap valuation. So what spreads are they are the returns you get from corporate bonds compared to the returns of government bonds. So the difference between the returns of corporate bonds, the yield of corporate bonds is still higher than average relative to historical terms. So on the left chart, you can see investment grade bonds, and on the right side, you can see high yield bonds, which is bonds by they have higher yields because the issuers have lower ratings. So you can see that on the left hand side, the investment grade bonds, the spreads have recovered, meaning that they're not as cheap as before, but they're still above average historically. So it's still in the cheap zone. And then for the high yield bonds, they have also recovered, but they haven't recovered as much, simply because there's more demand for safety now amidst the lower the economic situation at the moment. So, but now the higher yield bonds are still relatively cheap historically. Okay, and we can still see that demand for corporate bonds is still buoyant, especially during the low interest rate environment. So in Singapore, corporate bond prices, as you can see on the left-hand side by the Thomson Reuters IH Corporate Bond Index, you can see that prices have and are still rising. So the prices are still seeing demand for corporate bonds. And for the government bonds side of things, on the right-hand side of the chart, you can see that for the 10-year yield and the 5-year yield, for represented by the blue line and the red line, the yields are still declining last week. So this suggests that there's more funds inflowing into Singapore government bonds, simply because our government bonds offer higher yields than the US government bonds are. So we're still seeing there's still some attractiveness to the Singapore government bond side of things. So we're still seeing overall demand for bonds in the market at the moment. Okay, so that's just a flavor of the corporate bond side of things in the Singapore. Okay, so now moving on to our watch list. So right now, this is the watch list for our bullet bonds. Bullet bonds meaning that they have maturity dates. So it's quite an extensive list, but the overall theme for our bond picks during this season is we're focusing on strong stakeholders, meaning strong stakeholders such as Temasek, Hong Leong Bank, Warburg Pincus, this kind of PE funds that back this kind of issuers in Singapore, because we think that these bonds offer a better reward to risk ratio with this decent yields, especially when all the prices have already recovered in the market. So it's a bit hard to see this chart at the moment because there's a lot of things here. But what you can do is you can just email us, the email at the bottom there at bonds@phillip.com.sg, and we can send you this list in a report to you. Also, you can ask us any corporate bond questions from the email. Okay, so now this is some of the perpetual bonds that we're looking at right now. So perpetual bonds, just to refresh what perpetual bonds are, they are bonds with no maturity date, only call date, meaning that they're just like normal bonds, but they can theoretically go on forever if the issuer chooses not to redeem it. So that's why it's called perpetual bonds. So the two perpetual bonds we're looking at right now is SPH REIT and Escort Residence Trust. Two bonds issued by these two issuers. So mainly because of this, the reason is because that they both have substantial liquidity and low gearing to tide them through this period. So for this SPH REIT, it's a 4.1% perpetual bond. So at current price of 100.6, you get a yield of 3.94% per annum. So for this REIT, we like it because it's one of the lowest gearing. It has one of the lowest gearing in Singapore in the REIT sector. So their properties include Clementi Mall and Paragon. So based on our stress test, their property values can drop about 40% before the bonds are affected. So this is in comparison to in the GFC. In the GFC, the retail properties fell about 11% in the GFC, just for comparison. So they have quite a large buffer to tide them through this period. And their SPH REITs yearly rental income can last about 6 months. So they can go with 6 months without any revenue and still be able to pay off their yearly interest expenses. So so SPH REIT has a lot of buffer, especially for their for the bonds side of things. So, and we know that circuit breaker only lasted 3 months. We're already reopening the economy. So this is a good sign for the retail REITs as well. The next one is Escort REIT. So this is hospitality play. So we know that hospitality is quite battered down by COVID, but we know that Escort REIT, Escort Residence Trust is flush with liquidity, meaning that they can last for 2 years operating. They can operate for 2 years without any revenue at all. They can last for 2 years operations. And as countries reopen, we also can see that hotel occupancies are starting to pick up again. It's not really in the news yet, but in China, actually, we can see that the hotel occupancies actually rose from 7% to 40% in recent months. And in China makes up about 8% of Escort Residence Trust gross profits in 2019. So it's not insignificant portion of their gross profits. So these are the two perpetual bonds that we're looking at. Okay, that will do for the short update on bonds. Over to Paul.
Okay, anyway, this is our strategy report. Responding to overwhelming force is just to show that the response by the central governments and the governments in coping with this COVID is overwhelming, just to reduce the casualties. I mean, move on, next slide. Okay, anyway, we'll just run through some of the themes, the plus and minuses that we see as we move along to the third quarter. Next slide. Okay. Anyway, the first plus that we see is the monetary response. So we got the largest monetary stimulus on record. If you focus on the blue line, basically this is what the Fed is doing. The Fed is buying treasuries, which is your government bonds, and also mortgage-backed securities, which is housing loan bonds, in a way you can say that. And also they're even starting to buy corporates. So just to give you the extent of liquidity, the extent of money that the Fed is underwriting, or to at least to keep rates low, or even to reduce volatility, which is actually basically to reduce downside. So you can see the QE1, when we had it in 2009, it was, or N208, it was 300 billion, then 900. But right now, what the Federal Reserve is spending is almost 3 trillion. So it's even more than all the prior three QEs combined. The red line is just to show you the amount of debt that's being issued by the US government. It's like record high in terms of over the past 12 months. This basically means that this is the amount that they're raising money to spend on the economy, because they're going to hit record deficit. And almost 70% of all this debt is actually funded by the Fed. So it's a really pure monetization or helicopter. And then just to reinforce that, to remind everyone that they are going to backstop, they're going to keep on buying as much treasuries. They just said that they will buy treasuries and mortgage securities in any amount needed. Okay, and again, just to remind everyone, the fact that by the fact that they're going to keep rates low. This is the dot plots. This is basically members of the Fed that sets the monetary policy. They will tell what they think will be the rates for the Federal Reserve, Fed rates. So you can see the Fed rates are not going to move until 2022. And just to remind again, just to reinforce that they're going to keep rates low, to show how dovish they are, they just say they were not even thinking about raising rates. You can't even make this up. And of course, all this translates into lower interest rates globally. As you know, Fed is the central bank to the world. So you can see that for Singapore, at least our 10-year interest rates is about 0.9%. Record lows for Singapore. Of course, in Germany or Europe, it's really turned negative. And of course, from our perspective, at least, no, we don't. I mean, to be realistic, you don't see any value in government bonds except as a hedge. I mean, when the market is routed, when there's a market rout and so forth, so people will just use it as a hedge to escape all the extreme volatility. And of course, low interest rates is just a reminder. It's always positive. It acts as a growth. It's good for asset prices. It makes equities relatively more attractive. And of course, what it means is that yield is again the most valuable sought out after asset class. Okay, so just to swing back into Singapore, we can see the blue line. So Singapore is in a really good state. I think in terms of foreign reserves, we're in record high of 300 US billion. And you can see the table on the right. We absorbed almost 21 billion in just the first 5 months, and who knows, we could break the 2017 record. I think about 33 billion. In terms of domestic liquidity, that means the amount of deposits in the Singapore system, it also reaches a new high. I think it's about 750 billion. And the curious thing is that even though interest rates are so low, you can still see people holding lots of cash. So there's a lot of cash on the sidelines. Of course, part of it is foreign liquidity coming in, but again, just a reminder that there's a lot of liquidity in the system. Okay, just the other plus that we see that is positive for the market is the amount of fiscal stimulus. I think there's almost, this for IMF numbers, almost 11 trillion is going to be spent by the governments to respond to this pandemic, and and this is double what they are spending in terms of they are responding in terms of compared to the global financial crisis. the deficit that the government's incurred was 7%, but this time this is it's almost double, which is 13%. So in a way, you could say this is like a backstop that the government going all out to offset any economic weakness caused by this pandemic. Okay, and we swing back to Singapore. So you can see that Singapore, in terms of response to the pandemic, we are ranked probably the highest or not the second highest, because I mentioned before, New Zealand numbers can be over 2 years, but of course, it depends how you want to see it. The positive is that we can respond. We have the resources to respond. Maybe some emerging markets may not, because there's always a worry that if they were any major deficit spending might kind of cause investment grade downgrade and then kind of hurt their currency. But at least for Singapore's perspective, I mean, we have the resources to respond. So one of the biggest deficit spending, the government is like spending, going all out to support the economy as we are hit by this pandemic. You know, last year's deficit was 0.3 and 0.3 surplus, and this year is actually. And the other plus that we see for the market is, of course, there's a global effort to find a vaccine. As of right now, I'm just getting out. I'm not going to compile these numbers. I just got it out from the New York Times. That's almost more than 140 companies are at various stages of looking for a vaccine. Of course, whether it can get mass market, can support the supply to the whole world, that's another question. But at least we got Russians, Europeans, Germans, British, Americans, and of course the Chinese, all looking for that vaccine. And why this is important for us, I mean, as us following the stock market, is that not any news of a vaccine that approved stage, the one in red, then you know that it can cause a rally in the market. And at least at the phase 3, there are at least three companies looking to find they are close to getting the approval stage. But again, this can be months away or even a year away. Of course, the other positive is valuations, but again, Singapore has always been cheap throughout. And if you want to look at how, at least from the dividend yield perspective, this chart on the left basically means that would you rather minus 10-year bond yield is a way to read it is like, would you put money into the STI and earn the dividend yield, or would you put your money compared to the FD? So you can see that in terms of the spread, the difference between the dividend yield in the STI and versus let's say FD rate or 10-year bonds is a record high it's probably like more than 4% difference. So it's as much as as cheap as during the global financial crisis. The chart on the right is just to show how our dividend yield. So Singapore is, I mean, having to repeat again all over many times. Singapore just stands up for dividend yield. As you can see, our yield, that is the red line, is far higher than what you get in US or even in most parts of Asia, considering our currency. And on a PE basis, of course, when you look at the table on the left, you can see the blue line is at the average, which is the green line. Of course, that on paper that doesn't look attractive, but again, the market has already cut earnings. I think we estimated about 26% cut in earnings. So we are actually valuing the market at average levels on these are not normalized earnings. These are COVID hit kind of this COVID hit earnings. So in a way, we are overvalued, and you kind of, if you normalize it, we are probably at the one below the 1 standard deviation, that yellow line on the left. So valuations are still cheap. Okay, the big minus we have right now is the COVID cases are still rising. So that is the overhang we have right now. The world numbers are breaching probably 180,000 a day. This is the 7-day moving average, because if you take a daily number, it swings up and down, but just to take the moving average. The one that we were initially optimistic was the red line, which is the largest economy. So initially, US, China, Germany, they were all falling down, but I think because of the US, the number is rising back up again. The beige line that you see is the rest of the world. These are mainly the emerging markets like Brazil and so forth. Next slide. Okay, the positive we have, at least in Singapore, is the red line. Before we had the circuit breaker on 7 April, you can see that the red line, we were hitting 63 a day or almost 55 a day. But right now we dropped to 12. Again, yesterday number wasn't good. So yesterday is something that for us to kind of monitor, because we hit almost 25 cases. We are looking at the new community and imported cases. So when we were relaxing, when we hit phase 1 relax and another stage of where we hit phase 2, the numbers was about 5 to 7. So if you want us to maybe relax further into phase two, we probably need to go below 10. So that number yesterday wasn't a good number because you can see the big spike. Of course, hopefully we will never hit the pre-COVID 50 to 60. But if you want the economy the lockdown to ease further, we need this number to go down. Okay, in terms of the, also there's something to be positive about is that the COVID cases in those worst hit countries actually can be contained. I think you can see like China numbers, which is the blue line. It used to be 1,006, then now it's probably about 20, then South Korea hit 600, now about 30, 40. And of course, the worst one was Italy, used to be like 5,000 a day. Then they dropped to about 180. So it shows that it can be contained. Next slide. But of course, you need to wear masks. I mean, so the US have to wear masks. You can see that the US now hitting back to 45. The headline numbers you see, ours is moving average. The headline numbers you see is from the Johns Hopkins number, but we take this from the CDC, which is the authorities. So you can see that this is going to be a problem because otherwise the economy might swing back and then slow down with more lockdown. Okay, we move on to Wei Ren.
Hi, good afternoon, everybody. So I'm going to share about the one that's which we are sharing on the webinar. So it's kind of the same thing, but a little bit of update on the technical market on the STI. So move on. So yes, for the STI, this is the weekly chart. The weekly chart has shown some uptick, but price still remain below the key major resistance level at 3,000. So if 3,000 is not broken, then we will see that the price might be range. So ever since the sell down started in March, STI fell below 2,500 for the first time since 2011. And although it rebounded, like what I mentioned in the previous outlook, price rebounded near 2,305, which is a 161.8% extension level of sub-wave 3. So as of last month, prices had a strong sell down below 50% of wave 3, but as of last Friday, bullish engulfing was seen at the lower support of the channel, and today, as expected, price actually gap up higher. Price is currently trading as of higher as we are speaking now. So as such, we see a high probability of STI testing the resistance zone between 2009 to 2,954 in the long run. So except once the 50% level is broken. So in order for the market to resume its bullish outlook, the straight time index needs to break above the 3,000 psychological level minimally. Otherwise, the recent upside is still and will be seen as a corrective action. So the daily chart presents a clearer picture with price staying supported above 2,636.05 to 2,598.40 cents. As such, we believe that the index will test the resistance at 2,900, which confluence with our weekly chart analysis. So SDI has also broken out of the falling wedge on last Thursday, and together with the support and the rebound was the strongest past 2 weeks. And Friday, although Friday was since a bit of price weakening, however, as of today, price is closing in onto the resistance level that the immediate resistance level at 2,692 to 2,700. So this still remain a clear obstacles. This level once is broken, this obstacle once broken, then we'll see that it retest the potential resistance zone 1 again, which is at 2006 to 2008 region. So DBS also, out of all the stocks, I think DBS is still based on the technicals, based on the risk reward that we are having. So in the long run, we see DBS as a based on the technicals, we see DBS as a very rewarding stock to actually hold on to it. As Wee Guang has mentioned that the SG Bank outlook still remain neutral. So DBS group actually, back to the topic, DBS actually showed that the price rebound at $17.31, which aligned to our past report in March period and the Q2 2020 outlook. However, we are cautioned to take this rebound recovery as the earlier wave analysis and technical price action indicate that there might be another extension of wave C, means that price may actually move downwards. First, the stock closed below a resistance level of $22.50 after an intense sell down 3 weeks ago. So currently, price is still on the upside, but price is still maintaining at $21, still below $22 as I've checked last 1 hour ago. So as long as the stock stays supported above $20, the stock will likely test the resistance zone at $25. However, should DBS remain $22.50 to $23.24 range, DBS will likely form a complex corrective flat pattern. We will see price ranging from $22.50 to $20 range. Okay, next slide. Okay, so I move on to AEM. Okay, AEM, I recently issued a report, I think last week. So there's still weakness in momentum that sees stock entering a complex corrective phase. So AEM had a strong rebound on the last day of June after breaking out of the falling wedge, which you can go to my report for more details. And then what's more interesting is the breakout was within the bullish flag, or the larger bullish flag, like highlighted by ABC. However, the momentum did not last and was ranging for the next 3 consecutive periods with doji candle in place, signifying a halt. So even though there might be a rebound, I haven't checked the current price, so I will check it later. So even though there might be a increase in there might be a rebound, the falling momentum has increased the probability of a complex corrective wave or the double tree, and we should see price testing a $3 psychological support before a rebound to test the next resistance zone at $3.35 to $3.41. So in likelihood, if the resistance zone was rejected strongly, then we'll see that past the wave Y, as highlighted in the chart, may rebound at between $2.60 to $2.65. Okay, next slide. So for ComfortDelGro, downtrend still persists. Okay, so you can see that ComfortDelGro initial sell was met with a strong piercing line. We see price regaining its bullish momentum. Retest its resistance zone at $1.64 to $1.68. However, price did not price lacked the momentum to break again the resistance zone between 164 to 168, and then subsequently there's a continuation of sell down. And if you look at the chart from a bearish flag that I mentioned a few 2 weeks ago, our channel, if you may, evolve in the rising probability wedge. We see further downside opportunity. Risk, I would say opportunity, and then we see the stock plunging further as the pattern is considered a very strong continuation pattern. Why? Because this type of rising probability wedge is kind of a rare pattern, that rare continuation pattern. So we'll see a further downside. So we will see that price will test the immediate support at $1.36. Okay, next slide. So lastly for high P is actually have the same. Okay, the chart is okay. I didn't change the chart, so okay, let me do without a chart, because the chart I didn't update to high P, so there's some error, so we'll update it again. So for high P, just a brief one. Head and shoulder indicate a potential selling, and high P will enter into a complex double tree pattern, just like AEM. Okay, so if you can go back to your chart, you can see that AEM and high P actually has a similar type of pattern, corrective pattern. And then same as Valuetronics as well, but Valuetronics is on the downside. So we expect the first rebound at $1 region, and price should fails. And if price fails to break $1.15, we'll see another round of correction back to $1. So the resistance zone is a crucial factor, and your break and the truncated subwave 5 usually follow the impulse wave, will be much stronger as it lacks the momentum to break above. Okay, so next, so I think I will end off. I will pass back the time to my colleague for the sector views. Thank you.
Yeah, thanks. Thanks, Miriam. We'll just move on to very quickly the sector views. Next slide.
Hi, so for first, the property sector, the graph on the left shows the property price index and the number of unsold units. The more frequently mentioned number is the 49,000 units in the pipeline, which will be delivered from 2020 through 2023. However, if we look at the number of unsold units, which is represented by the blue line in the graph on the left, only 29,000 private housing units are unsold. And this number of unsold units has fallen by 20% year on year from the high in the first quarter of 2019. The price index, represented by the red line, has experienced 2 quarters of decline, dipping slightly by 1% and 1.1% in 1Q and 2Q respectively. So the graph on the right shows the sales momentum for new units. Showrooms were closed during the circuit breaker period in April and May, and developers have resorted to giving virtual tours instead. Understandably, sales volumes were lower, but developers still managed to move 279 and 486 units in April and May respectively. While sales volumes recovered 70% in May, sales in May were still down by 43% year-on-year, as seen by the position of the red line, which is below the black line. So we are not expecting a sharp fall in property values, but rather a mild correction. We expect private homes prices to fall by about 5% in 2020 and volumes to come in at the 5-year average, which is about 8,000 units. So we see 5 factors supporting the property prices. Firstly, land sites for 6,670 units were released in the second half 2020's government land sales. In the graph, you will see that the number of new units released has been kept at around 6,000 units over the last 4 quarters. This is the lowest compared to the number of units released over the last 10 years, which ranges between 8,000 and 14,000 units. The government has reduced the supply of private residential units on the confirmed list, which is indicated by the blue areas. The number of units on the confirmed list in the second half of 2020 was 1,370, down from 1,775 units in the first half of 2020. This lower number of units on the confirmed list, this is the lowest number of units on the confirmed list since the GFC, where 1,100 units were released in the second half of 2008, and no units were released for the first and second half of 2009. So secondly, the lower interest rate and lower selling prices will help to spur sales. The reference borrowing rate, SIBOR, is down by almost 1%, and prices are more attractive as developers have lowered their price expectations in order to maintain selling traction. Thirdly, the stabilizing policies passed in the COVID-19 bill will help to keep prices stable, and the allowance of loan payment deferments prevents homeowners from defaulting and having to liquidate their assets. The extension of ABSD deadlines also prevents upgraders from letting their options to purchase lapse in order to avoid ABSD charges if they are unable to sell their existing properties. So fourthly, higher land prices over the last few years does not leave developers with much room to cut prices, as they will strive to protect margins, so we do not expect deep discounts to be given. Lastly, we see that households seem to have a stronger balance sheet, as seen by the lower LTV ratio of 49% compared to 53% 2 years ago. So I'll show you this chart shortly in the next slide. So move on to the next slide. So in the graph on the left, the red line shows the property price index. And as you can see, there are 2 periods where we saw strong price appreciation, where the price index grew faster than the household income, the red line. The price index has corrected slightly and is now below the blue line. So as mentioned previously, the price index has dipped by 2% in the first half, and we expect another 3% in the second half. In other words, the present is a comparatively more attractive environment for home seekers and upgraders. The graph on the right shows the LTV on outstanding home loans, and we can see that over the last 2 years, the LTV ratio has been declining, suggesting that homeowners are better capitalized and have taken out less loan financing. Okay, I'll pass the time back to Paul.
Yeah, thanks, Natalie. We're not going to run through the whole slide deck. We'll just run through some of the key sectors. So we took out REITs because Natalie provides quite a lot of updates anyway. I mean, for the telcos, I think the key is this line. I think we are neutral on the telco sector for at least the next 2 to 3 quarters, because without the international travel, inbound or outbound, the roaming revenues that they get is going to bite. They never give the exact number. So like the first bullet point, we think it's almost 10 to 15%. And a reminder that this roaming business is a very high margin. It's almost pure. I don't say 100% pure, but it's really almost pure profit, since any tourist that comes in, you hardly have any extra cost. They're just stepping on your existing network. But I need just to show you how the weakness is. I think you can just focus on the blue line, which is StarHub's ARPU, or basically the selling price for their postpaid. So it used to trade $70, so this was the golden years in a way for StarHub. But then it took a gap down after TPG was awarded the license. I think in response to the arrival of TPG, the 4th mobile operator, and no surprise, even Singtel, let's took their prices down. So I think that's the reason why TPG is going to have a tough time, because whatever profit pool that was left in the market was already been taken out by this collapse in pricing. Then we got the next collapse in price when the arrival of international, when the impact of due to the reduction, almost zero international and outbound and inbound travel. I won't run through every point, but the next one is, of course, Optus is the other one. The big problem for Singtel especially is due to the loss of, due to Optus, I think they lost NBN. NBN is like a fixed, the fiber connection. So without that, they cannot, they lost a high margin business. They used to sell their corporate customers and consumers broadband using their own network, but then now they have to use, it's like our so-called Netlink NBN equivalent. So right, because of that, they lose out. Anyway, okay, and then for the emerging markets, it's also going to be weak because emerging markets is different from Singapore, where we pay every month a fixed amount, but emerging markets is like a pay per use because it's prepaid. So when the economic situation is weaker, and if you then there'll be less spending on telco services. So that's another pressure point for telcos. I mean, this refers more to Singtel because they have Indonesia, Philippines, and India. Next slide. Okay, for land transport, I think we know how dire it is. I can just look at the blue line. This is the amount of people traveling on the rail. The next slide is that's why we are a bit more cautious on comfort, even though things should be recovering. But the gray line, the ratio of private cars to taxi, you can use this as the Grab line. The number of Grab cars to taxi, you can see continues to rise. So competition continues to surge, and the number of taxis continue to drop. But the only comfort we get, i.e. comfort, is that probably they are gaining share. I think the most of the reduction is probably from their competitors. Okay, just a quick one. We don't cover marine sector, but just to show you the situation right now. You can see that the order books for Keppel and SAM, that's in the red bar. In 2018 was 7.4 billion, 39 billion. 2019 was 6.84 billion. It already dropped even before we know the recent collapse in oil prices. And what we're going to see is that that it follows the blue line. The blue line is basically the oil capex by the majors. So what has happened is that the capex by the oil majors is going to drop from 193 to 151, almost 20%. So you can imagine what's going to happen to the account of orders that they are going to get, because the oil majors, the oil majors are referring to Esso, BP, Exxon, and Shell, and so forth. So you can expect another very, very weak year in 2020. Probably 2021, you might see some improvement. But again, you can see that even when CAPEX recovers in 2021, sorry, you can't see the number there. It's not going to reach anywhere near the 193 or even the 189. In terms of technology, the only message we can say is that the hardware spend should be resilient. It won't be like ultra robust, but it's going to still grow, maybe low to mid-teens. As you can see, there's a lot of spending on e-commerce. So this is the US growth in non-store retail sales. You can see that the spending is shifting online. It's a record growth for the last 10 years. You suddenly see a big spike of more than 20% growth, the chart on the left. And also another thing supporting technology hardware is that consumers are moving away from experiences. Since you can't travel, so a lot of your budget is going to shift from services to goods. So that will help the hardware sector. And the table on the chart on the right is just to show you that as we work more, game more, play PS4 more, I guess, spend more from at home, there's going to be a lot more demand for cloud capex. So we have a cloud capex proxy. Basically, it's a proxy of spending by Facebook, Amazon, and so on. You can see that it's still going to grow 11 and 14%. So it's just going to be resilient, obviously, I mean, among the other sectors. Okay, I'll move on to our absolute 10. Again, this is our so-called model portfolio. For the quarter ahead, the changes we made are in red. So these are the new additions. What we took out were like Sheng Siong, StarHub, and UOB. Again, doesn't mean, like for Singtel, doesn't mean the outlook is bad. Just that it kind of hit our share, our price target, because the share price has done really well. So what we added was Asian Pay TV, DBS, and Yoma. The table on the right is basically the performance of the fund. I think we got hit a lot, mainly because of StarHub. So I mean, although we outperformed the STI by a huge amount, but again, no, our purpose is to generate absolute returns. It was down -7.4. Again, these are just for illustration, because to keep it at 10%, so we have 10 stocks issued at 10%. So there's technically a rebalancing every month, and of course we don't take into account the cost and so forth. But of course, we also don't take into account the commission, the dividends that are being generated by this so-called model portfolio. Okay, next slide. We will start with DBS.
Yeah, okay. So for the first confer in our absolute 10 is DBS. On the left-hand side, you can see the first quarter highlights from DBS. What we see is that heading into the second quarter, we see more of the impact from the COVID-19 across the three income segments: net interest income, net fee, commission, and other non-interest income. We saw robust growth across all of them. It provides a buffer for the slower growth that will be coming subsequently for the second quarter and onto financial year 2021. However, as we mentioned just now during the banking monthly, what we see is that heading into the second half, we will see wealth management and brokerage related fee to benefit. And for DBS itself, having a stronger investment banking franchise will put them above OCBC and UOB in terms of how likely they are to recover from the second quarter. So furthermore, they're also providing a very attractive quarterly dividend of 33 cents, which represents roughly a 6% annualized yield. Whether or not they will be reducing, what we believe is that right now for the financial year 2020, they are likely to hold this dividend level throughout. And for financial year 2021, if things worsen, then there is a possibility of them opting for a scrip dividend, or maybe revise their dividend policy only then. So right now we are having a neutral rating, but the main thing to note is that for DBS itself, is mainly a yield play of having about 6% yield, which is good, and having a target price of around roughly $20.60. Yeah, and that's it for me. Next, pass back to Natalie.
Okay, so for Escort Trust, you might have heard this before, but we like this. We like Escort due to the stability and the outperformance of select service accommodation types. So if you see in the pie chart on the left, this is basically the breakdown by lease type. So the blue side, the blue portion actually represents the management contracts. So it's the growth or variable income. And the red and green side actually represents the stable leases, which come from your master leases, the portion in red, and the management contracts with minimum guaranteed income, which is the portion in green. So and this red and green portion is the one that provides more or less fixed recurring sort of income. It helps to keep the DPUs relatively stable. So Escort usually tries to maintain a 50-50 split between the growth and stable income. So the second pie chart is basically the diversification by geography. So as you can see, amongst all the hospitality S-REITs, Escort is probably the most well-diversified one. Additionally, they have 88 properties across 15 countries. This actually means that there's very low concentration risk per asset. So if you look at the graph below, this is their sponsor, which is the Escort Limited's growth in the number of keys under management. So the sponsor has been aggressively trying to grow the number of keys under management, and currently there are about 100,000-ish kind of keys under management, and they intend to grow this over 4 years to 160,000 keys. So that's a CAGR of approximately 17% a year. So how this benefits ART is that the more number of properties that is branded under the Escort brand, which are Escort, Somerset, Citadines, and Live, then the more prominence ART's Escort branded accommodations will have. So ART will benefit from the global footprint, as well as the increased brand recognition, and also benefit from being part of their loyalty program. The last point is that select service accommodations, they are actually growing in popularity, and this is partly to do with the customers' preference for value, and also that select service accommodations are also of a lower price point and have a larger room format. So I mean, in this weaker economy, this service select accommodations with their lower price point is actually poised to benefit from this weaker economy. So for Fraser Singapore Trust, we like them because of their resilient necessity domestic spending and the outperformance of urban malls. So and second of all, we also like Fraser Singapore Trust due to the organic and inorganic growth that we see. So in terms of organic growth, the number of HDB units surrounding their three largest malls is projected to jump by about 67%. So in the graph, the three largest malls are Causeway Point, North Point City, and Waterway Point. So the red dotted line portion actually shows the number of units that will be increasing in these respective catchment areas. So of course, this will bring more footfall and more tenant sales to these three malls. For organic growth, apart from the pipeline of 3 assets from their sponsor, Fraser Centrepoint Trust is also, along with their sponsor, which is Fraser's Property Limited, has invested in a private real estate fund that comprises of suburban kind of retail assets, very similar to the kind of assets that's held in Fraser. So in the last week, FCT actually acquired the remaining 12% stake in this private real estate fund, and the intention is for FCT to, or rather for these PGIM assets, right, to be injected into FCT's portfolio, and this will help FCT grow its DPU, etc. Yeah, and we do feel that this organic growth catalyst is very imminent. For CapitaLand, we like them because of their quality recurring income, which is growing. So in 2019, this recurring revenue portion contributes 1/3 of the revenues. So this recurring revenue actually comes from the fee revenue. A lot of it comes from their fund management platform. The graph on the left actually shows you the growth in the AUM of the REIT and private vehicles. So CapitaLand actually charges a fee for the management of these assets. So as the AUM grows, the fee revenue also grows. Yeah, CapitaLand is also capital efficient, and they have a very disciplined asset recycling goal of $3 billion every annum per annum. Sorry, and they are also able to tap on external capital providers. So one way of it is through the REITs and private funds, as mentioned. Sorry, I just want to mention that another portion of their recurring income is actually from their lodging platform. So it's their wholly owned asset, which is called the Escort Limited, which is, if you recall from our Escort slide, they are also trying to grow their keys, the number of keys, very aggressively, 17% CAGR of 70% per annum. Yeah, so that is where the growth in recurring fee income will come from as well. Lastly, to unlock new geographies, which is India, and asset classes, which is so that's all for me. I'll pass the time to Jie Hui for Yoma.
Thanks, Nat. Okay, next we have Yoma. We like that Yoma is entrenched in Myanmar's fast-growing and attractive consumer segments, namely in the mobile finance, property, consumer, and automobile segments. In the property segment, it has a large property land bank equivalent to 10 to 15 years of sale, and the projects in the pipeline to monetize this land bank includes the up-and-coming Yoma Central that is due in FY21, Star City, as well as the Peninsula Yangon. Financial services are also poised for growth through its key driver, Wave Money. This is the key jewel for Yoma. Just a bit of background, Wave Money became profitable within 2 years of inception, with revenue up by 5 times year-on-year and 16% quarter-on-quarter last quarter. As you can see from the chart on the left, Wave Money's transaction volume grew at a CAGR of 65% since 1Q17, and this is attributable to its brand leadership and large network of Wave agents in Myanmar. Better yet, Yoma actually recently announced an increase in stakeholdings to become a controlling shareholder. This creates opportunities for Yoma to integrate Wave into its existing property and consumer business lines. Next slide, please. Its growth in the F&B segment is also underpinned by a 60% growth in KFC over the next 3 years, and this is just on store openings alone, excluding organic growth. Yoma is expecting the number of KFC stores to increase from the current 45 to 75 stores should Myanmar's economy recover. If you see from the chart on the left, the total number of F&B stores is to grow to 125 stores from the current 91 stores within 3 years with the growth of KFC. Lastly, we find current valuations depressed in view of structural growth. Financial services and F&B will be the growth drivers for Yoma. Our SOTP derived target price of 46 cents includes a conglomerate discount of 20%. Now I'll pass my time over to Paul who will conclude for the remaining topics.
Thanks, Siri. I'll just move on quickly. The other stock is Asian Pay TV. Obviously, it's not the most popular because they cut dividends for the past 3 years. But just a reminder, they are a monopoly. They provide cable TV access in Taiwan. So what has happened is that the two reasons why we're positive. Firstly, the dividend is more sustainable now. I think in the earlier years, you can see 2014, 15, 16, the red line, which is the amount of dividends that they were paying, was far higher than the free cash flows being generated. Then eventually they took the bite and cut the dividends. And as a result, you can see now that the blue free cash flow is much higher than the dividends, which is in red. So that this should, at least this will sustain the dividend yield, which is currently about almost 8%. The other thing that we like about Asian Pay TV is there is optionality. So it's not just collecting this. As you collect this 7.8% yield, there is going to be there will be a rise in revenues as once 5G rolls out in Taiwan. The mobile operators will want to use their backhaul. Backhaul basically just a fancy term for all the fiber connections that they have. So when you want to connect one base station to another base station, rather than they build their own network, they can tap on Asian Pay TV's fiber connections. Of course, they never mentioned the amount. All that the company said that it will be material and it will happen soon. So, but again, I do not know the timeline. It's really hard to extract it from them. So we have a buy and a target price of 15 cents. Next slide. I think we all know about this company, Netlink Trust. I think nothing much. It's just very stable. If you want just something with yield and very minimal impact to COVID-19 is Netlink. And again, whatever they spend is protected by the regulatory because they are at least until now, until the next revision, they are, for whatever they've been spending now, they will get a pre-tax IRR of 7%. Next slide. Okay, for prop next, we like it because it's probably one of the best financial metrics among many SGX companies. The ROE of 24, and again, all they need to run the business, I mean, I'm just exaggerating, it's just fixed assets of 3.5 million. They are the largest, so they've got the huge market share, so very rare to get any company in Singapore with such a huge market share in terms of a new launch or in any sector. Okay, but there is a caveat. I think they're going to be cyclical. So you can see from the red line, with the circuit breaker, obviously nobody's going to buy. Surf online and go and buy a property. So you can see that on the red line, the units sold. This is the 3-month moving average has collapsed almost 50% year on year. So you're going to see, of course, the first quarter the results was up almost 3 times, but in the second half you're going to see very big results because of the COVID. But again, we think we still like it, even though because they're going to maintain the yield. I think they've clearly stated that they want to keep this stock as a yield play, and to maintain this 6.7%, they need to pay 13 million a year, and they've got like a 90 million net cash balance sheet. Next slide. Move on. Last one. Second last one is Thai Beverage. We like it mainly because they got a huge dominant market share. I mean, they really just own the whole spirits market in Thailand. The second bullet point. And okay, but near term they're going to get hit. What has happened is that there was a 3-week alcohol ban in Thailand. So April sales, you can't see on this because this is a 3-month moving average on this chart. But in April, liquor sales, spirit sales dropped 50%. The good news is that it actually recovered 32%. So our view on this stock is the second last bullet point is that you're just buying this at attractive 14 times PE. You know, most consumer stocks trade about 20 times. And also that 14 times is on earnings that is depressed. So this 14 times earnings is when you got this 3-week alcohol ban. There is the bigger problem is the Sabeco. As you know, this is the largest Vietnam brewery. The problem is that in the medium term, they're going to suffer because I think the authorities is clamping down on drink driving. And I mean, to our surprise, actually, this is enforced very tightly and it's hurting a lot of consumption on premise, like in bars and so forth. Okay, next slide. Of course, for us is venture. I think, as we mentioned earlier, we think that hardware, electronics will be resilient. And the other two trends supporting venture will be the supply chain shift. As we know, due to the trade war, electronic supply chains at least, moving out from China into Southeast Asia. but there is going to be a disruption. The thing we worry about is this blue chart, which is exports out of electronic export out of Malaysia, and because they have a big presence in Johor, so we're just worried that the second quarter, not so much demand, but just that the whole supply chain disruption might actually affect them. But again, we like it again because they got like 4% dividend yield and high net cash and so forth. Okay, move on, next slide. So in conclusion, we think that the backdrop that we have right now is positive for equities. Firstly, there's a gradual recovery. The good thing about gradual recovery is that the aggressive monetary easing is going to remain. I'm not saying that all this easing is going to help the real economy, but it's sure going to help the financial markets. And of course, the caveat is that any rebound in the economy is going to follow the outbreak. And our equity strategy is really centered around dividend yield and also those companies that have a huge dominant market share and so forth, but just that there's a near-term impact from COVID, and then we will want to buy into their normalized earnings. Okay, that's it. We can take on question and answers if anyone has. Thank you for your participation. Viren, you want to help out on some or?
Okay, let me review. There's a question on UMS. So UMS actually have broke out of the pennant. So, or you can say that is a descending triangle. But however, we expect price to actually break the high of 0.96, the resistance level, and then subsequently 0.995 to $1. So if you can break $1, and then we'll see UMS going into in the long run can go to 1.075, which 161.8 161.8% extension level of the pennant. Okay, so but however, after this kind of strong move, we expect some low volume and corrective action. So yeah, that's right. Okay, so I hope that answers your question. Thank you. So for CMT is a capital mall trust. So capital mall trust, same thing. It has been on the consecutive upside, but it's not very strong. So support remain at 1.94 to 1.91. And then we can see that the immediate resistance still remains at 2.96. The good thing is it's still trending above $2. So let's see if you can. I think there's a positive upside that you can go to 2.13 minimally by these few periods, which is like the next few days. All right. So I hope that answers your question. Thank you.
Okay, we got a question here. Again, thanks for all your questions. What is your view on ComfortDelGro transport business investment in China as it is opening up their economy, domestic and foreign travel? Would this not help ComfortDelGro? For China alone, the revenue is about 155. Singapore revenue is 2.2 billion. So China is less than 10% of Singapore. And the rest of the company, I mean, it will help definitely at the margin. I think the combined UK and Australia is about 1.4 billion. It will help definitely, but taxi business is going to be the main profit generator for them. So that's why we think on balance, it's still going to be a negative for them because of the competition. That's where we are coming from. Of course, you can always just play on the news flow that things are opening up, but our view is just that the competition won't run away, and it's actually intensifying. That's our view. Thanks. Okay, are there stocks that you don't cover but find interesting or attractive? Of course, there's a lot of stocks that we find that sometimes we don't have the time or at least the resource. But of course, gloves will be the best. I mean, in terms of momentum, I think we all know that. I think you're going to have a super stellar year, lack of better word, because it's not only that, what is happening is that as prices rise, right, all the price increase that you see that the girls enjoying is going to just go straight to the bottom line. So however forecast we have is the market has is probably a bit understated because you probably won't know because it's going to be all pure profit from. And as we mentioned in our prior briefing, wherever you order now, you only going to get it. There's a lead time of of 400 days. Used to be 30 days. That means you order now, you get it 30 days. Now it's 400 days. Can you talk about your thesis for IREIT, Jerry?
Hi. So our thesis for IREIT is that the dividend yield for IREIT is actually pretty good at 7%. And then what's attractive about this stock is actually that it provides a lot of stability, because the income stream that is coming from IREIT, about 86% is actually hinged by very strong tenants. Like for example, one of it is actually GMG, which is a wholly owned subsidiary of Deutsche Telekom, which is one of the world's leading telcos. And then DRB is also Europe's largest statutory pension insurance company. So sorry. Yeah. So like with 86% of the income actually hinged by very, very strong tenants, we see very good stability coming from this stock. And then the high yield is also what's attractive about it. The bill for the portfolio is also longer than that of Singapore REITs. So if you are looking for a European exposure that will provide stability for your portfolio, I think this is a very, very good counter to look at.
Oh, okay, the next one is, can you talk about your thesis for Penguin? I think for Penguin, it will be a challenging year. This, I think we mentioned it before. Most of their order books are intact, but I think, we cannot hide the fact that with the oil price at these levels, it will be a challenge. But just that for us, we think that as this cycle turns over, they are they are probably in the best position. I mean, they're not going to do a big rights issue like some of the other yards. Yeah, and they've also expanded their product lines. Just that they're going to dampen the next 12 month orders will be a bit will be obviously dampened a bit the way oil price, and some of them are ferries too. Because there's no tourists going to sit on any ferries these days, so obviously there's going to be a short-term impact.
Hello, can you hear me?
Yes.
Can you hear me? Can you hear? Okay. COVID affects Escort performance. Yes, it does. Okay, so for currently, I think there are about 18 properties that are closed due to due to different regulations in the countries. So 18 of them are currently still closed. Apart from that, as mentioned, like one thing to note is that Escort has there are different leases that are in place for different assets. So you have your stable leases which are earning a flat kind of revenue, which is your master leases and your management contract with minimum guaranteed income. And then you have the more variable ones, which are the management contracts. So these variable ones, they are basically exposed or responsible for the P&L of the property. They derive revenue from the room rates as well as the occupancy. So that's the more variable side of things. But one thing for Escort is that because they service a lot of a large portion, I think about 41% of these management contracts come from the corporate segment. So the corporate segment actually has longer stays and of like anywhere from 2 weeks to 3 to 6 months. And this is the part where it has given Escort longer stays and more income visibility. And actually, if service residences have been outperforming hotels, especially during the COVID period, because they still had their base of long stay customers. So if you're saying COVID affects Escort, I would say that COVID affects all hospitality stocks. So, but just that Escort is less affected than most of the hospitality stocks, especially the hospitality S-REITs. Yeah, I hope that answers the question.
Okay, I'll just move on first. Can you give some insights into Jaffa? I'm sorry, we don't really cover Jaffa. I'm so sorry for that. Next one, next stock volumes on the low side. Any risk of this illiquidity? Sorry, I'm not sure how to answer this, but yeah, the volume is on the low side, and really, they also know this, and they just nothing much you can do, because you can see no one selling or also no Yeah, yeah. I don't see that issue. I think more important is the liquidity of the company, I guess. Yeah, but yeah, can't help on that part of the liquidity on share. Any 5G? Yeah, Timothy, yeah, you go ahead.
Yeah. So for the high yield bond yield funds, there is a risk of default, as you know. So, but that's the thing, right? For our strategy is we go with those that have strong backers, so that those actually have more connections to funding sources and give a better risk to reward ratio. So that's our take.
Okay, the next one, has 5G any impact on Netlink? Minimal. I think the impact, the immediate impact will be all the connections they will put to the lamp poles. So, but they're still very, very small. I think they've already reminded everyone that any impact from 5G will be, don't expect much. The next at least 1 or 2 or even 3 years. It will take some time. Synergy, any idea why the sudden jump in price and volume lately? I'm not sure, but we will try to get them on in one of our webinars. Then hopefully you can ask them. Is UG Health still? I mean we know them, but we don't cover, so not fair for us to say. So, but again, this is another company that we hope to get them on in our webinars. So hopefully you can just ask them. Jehu, you want to take the question on I can read it out.
So the contrast. Okay, the question is, how do you contrast Cromwell and IREIT for European REIT exposure? I guess both are offering different different kinds of, okay, not say exposure, but Cromwell is a logistics and a office play, and then even though I think, if I'm not wrong, right, quite a bit of, I think sorry, like 70%, quite a substantial portion comes from the office play. But I think the logistics portion also plays a pretty big role in helping to form the stability for Cromwell. It is also pretty diversified, I guess. Yes, a number of as in definitely a lot of properties, and I think if I would say the difference between Cromwell and IREIT will offer more stability due to the large tenants that are actually large tenants in this portfolio. Whereas for Cromwell, because it's more diversified, and then like yes, logistics tenants as well, which will actually, as in like some of it are actually small and medium tenants. So as in, I actually do feel that IREIT will actually provide stable exposure, whereas if you are looking for a diversified play, you may look at Cromwell for that. Maybe Natalie, you like to add more?
Oh no, it's okay.
Okay, can we just move on to the next? We try to end this by 12:45. I think Viren has another. Okay, the chart on Asian Pay TV shows that free cash flow expected to increase in 2021. What is supporting this increase as the free cash flow is expected to trend down? Or what is supporting is mainly the capex. So the capex, they are spending capex now, which is not generating any revenue because they are dancing. They're making the fiber more. I think basically they're just boosting the capacity of their fiber. So of course, when you do it right now, they're not generating any revenue, but it's mainly a earmark for 5G rollout. Next one, can you see further upside for capital? Okay, I'm not sure, are you referring to technicals or, but if you don't put technicals, so I guess it's a fundamental question. Right now, a lot of pressure points on Keppel since they own telcos and they own the yards. But because there is the partial takeover, so that will support the share price. But I think once that is over, I think the thing might just come off. And also, I guess the next catalyst for them is maybe they can do something like what Semcor Industry did. I mean, you just divest the yard, give it back to your parent. We know who that is, but you give it to your parent, and then your share price can just get a boost. So, yeah, that is. And again, we don't cover, but it's just some initial thoughts. Next one, can you share your view of Mapletree Logistics Trust? Any view of the target price too?
So actually we don't cover Mapletree Log, so we don't really have a target price for Mapletree Log. Yeah. I mean they recently just acquired a new asset in Queensland, Australia. So I guess you can say that, and also with their share price so high, they're probably re-entering the phase of trying to grow their asset base again. So I guess this is the part where it's uphill. I mean, it's going to be upwards for a positive trajectory for Mapletree Logistics. But then actually we cannot really comment too much. Is as we don't really follow or we don't really like cover this counter. Yeah.
Okay, next one, what's the TA for Sheng Siong?
So actually, I believe Wayman has actually left the conversation because he needs to set up for his next webinar.
Okay,
So
okay.
unable to help you with the TA for now.
Okay, can you provide insights into Rex? Sorry, Rex, we don't cover, but again, it's just a play on all price. Any comment on Manulife REIT?
For Manulife REIT, currently we do not cover Manulife REIT, so there's no target price once again. We do like Manulife REIT, as a US REIT and in the office space. So currently their yields are still quite attractive, around 7-ish, 8%. And this is, I mean, they have a portfolio of prime, grade A and trophy kind of assets, so which are considered more stable or more desirable kind of assets compared to the grade B kind of assets. So in other words, that it will help them it will make them more stable or less. Okay, sorry. And also, right, they have longer WALE compared to most of the Singapore kind of office REITs. Their WALE is about, I think, 5 years versus Singapore REITs, office REITs, about 3 years WALE. So in that sense, more visibility, and not to mention because of this longer WALE, there's actually less expiries coming due. In the next five years, or rather in the next 3 years, there's less expiries coming due. So meaning to say that even if the environment right now is currently weaker, they still have a lot of leases that are locked in that their tenants cannot break the lease on. So in a sense, that is the positive part about Manulife REIT, or rather the US listed REIT, US REITs. Yeah, I hope that answers the question.
And I think eventually the market might re-rate positively all these foreign REITs. I think once maybe next year when the pandemic more settled down, then everyone will just measure each other's operational performance. Then you might even be surprised the overseas REITs actually perform better in terms of sustaining the yield. Then there could be a big re-rating then. Okay, the next one. What is your views on HRNet? We don't cover, so I mean we do meet them, talk to them, but not fair for us to comment too much. So, what's your take on URL, Natalie? You have any?
Same, we do not cover, so we cannot comment.
Okay, move on. Can you advise on Jardine Circle Carriage? Okay, we don't, but I mean some basic thoughts is that obviously they own very, very good business. I know they own the Astra, they own Vina Mill, Siam City Cement. So I think longer term they are still very really good company, just that in the near term, all these are highly cyclical business. I mean, apart from Vina Milk, but like cement and auto sales are all going to get hit temporarily. But again, these are really probably one of the best assets in Southeast Asia that you can get. So this is just our general view. Okay, the other question, is it better to buy, we just take the next three questions. Is it better to buy individual stocks or index funds in the current situation? It really depends on you. I think it's hard for us to comment on your behalf. I think most important is your conviction levels. If you know some stocks that you're more comfortable with, then you can buy them directly. But if you're not too familiar, then it's better to just buy the index funds. The reason why we say that is because that if there's any whipsawing of the share price, suddenly there's a bad news and then the share price come off. If you don't have high conviction levels, then you get whipsawed and you might just sell at the wrong time. Whereas if you buy index funds, then this across the board, you'll be a bit more comfortable. So it really depends on your conviction levels and your temperament, I guess. I hope that answers it. Is there any updates on First REIT, Natalie?
For First REIT, no, not that we know of. I mean, there's one announcement that the company released about some I think the construction that was delayed due to the road works. So I think that's not really very pertinent here. But yeah, I guess that you're actually referring to the master leases that are coming due, but no, there's been no update so far.
But but we think the outcome won't be great, I guess. Yeah, it's just too over. They're just over. They're getting. They're being overpaid. Basically the sponsor is overpaying for suite in terms of the rent. I mean, to be direct about it.
Yeah. So any comment on US REITs? I think similar to my answer on the Manulife. So the other US REITs, Prime, Keppel, Pacific Oak, they both have longer WALEs compared to Singapore office assets. Yeah, and I guess it benefits in the near term, especially because there are less leases coming due or expiring. Then and especially during this more volatile or more sensitive period. Yeah, so that keeps them a little bit more protected than the Singapore office REITs.
Okay, we answer last three. Hi, please comment on S&P Nasdaq. Is so high. Will it be currently dangerous to Singapore? What should we do? Okay, we don't cover US, but I mean, just to give you some context, most of the rise you see in the US is linked to a lot of the e-commerce stocks. But if you look at transport, the other stocks, actually they're probably down like 20%. So I'm not saying that they won't come down, but I'm just saying that it's probably rightly pricing in that the beneficiaries are all these e-commerce plays. The impact to Singapore, yeah, of course, if there's any big sell down in the US, it would definitely hurt Singapore stock because the correlation is pretty high. And I mean, if you're a bit more wary, then just buy the safer stocks. They are less affected, less cyclical, maybe like a Netlink and those high dividend yield stocks. This is just a very generalized comment. Second last one, any comments on EC World regards to investigation?
Yeah, okay. So with regard to this investigation, I believe that actually the CAD mentioned that this investigation into their CIO has nothing to do with the REIT itself, or the management of the REIT. So in other words, I guess it's not supposed to affect EC World, although the market doesn't seem to be reacting that way. Yeah, so I did reach out to the IR, but yeah, that was the comment that came back, that this investigation actually has nothing to do with the REIT or the manager.
Yeah. It reflects is regarding one particular individual.
Yeah.
Okay. Any comments on APAC versus PropX? I mean, if you just look purely at market share and the performance, revenue, and profit, you can see that PropNext is outpacing APAC relative. And also, we like the cleaner balance sheet of PropNext. There's no this pure cash, whereas APAC they still have a property. Again, nothing wrong with that. It's just your preference. Last one, what happened to VCom? I think VCom just going to get affect. I mean, when there's less volume of cars, less or less taxis for them to work on, then I guess that would be the impact. Sorry, I'm not the expert on VCom, but I guess that's the general understanding we got as we cover corporate.
I think they had a share split.
Oh, okay. You mean that? Okay. I thought
4-1.
Okay,
1-4.
Oh, sorry. I thought you were referring to operationally. Oh, okay, yeah. Okay, thanks, Timothy. Yeah. Okay, I think with that, sorry we have to rush. Just that Viren has a big webinar at 1 o'clock on US technicals, and that one usually very well attended. So sorry we have to end it now. And thanks everyone for attending and also for all your questions. And hope to see you in 2 weeks' time. Thank you, everybody.